So we've learned how to prepare the financial statements, and we know what each one of the financial statements tells us about the company. But we can also dig deeper and learn more about the company by performing financial analysis. And so financial analysis, we can use it to evaluate the past and then kind of help us predict where we're going. We can find trends with the company. We can find potential warning signs where we need to focus attention to improve. And we're going to look at three analytical methods: horizontal analysis, vertical analysis, and then ratio analysis. This is going to be your financial analysis assignment, is going to be doing ratio analysis for two competitor companies. But let's talk about the other two methods first. So horizontal analysis is where we look at the change from the previous year to the current year. And we're going to calculate the change as a dollar amount by just subtracting the previous year and the current year. And then we're also going to find the percentage of the change. And the percentage of the change is by taking the dollar amount of the change and dividing it by the previous year. If you are doing horizontal analysis on 3 or more years, then the earliest year is always the base year. It's always the denominator when you're getting the percentage. So when we do horizontal analysis, we can compare changes in related items. So for example, you should be able to go to your income statement, and the change in cost of goods sold, the percent change, should be approximately what your sales change is. You can also look at changes in the balance sheet and compare them to the related changes in the income statement. So for instance, your change in accounts receivable, compare that to your change in sales, because those are related items. You can also look for explanations of large changes. So if you see a large change, you're going to want to investigate and find out why we had such a large change. So here's an example of how you do horizontal analysis. So we're taking a look at the balance sheet, and we can see 2020 and 2019 for cash was 105 in 2020. 2019 it was 150. So the change was, it decreased by 45. So a lot of times we have the current year and then the previous year is next to it for comparisons purposes. So that's why we can see one from 150 to 105. So that's why it was a decrease. And then we took the 45 and divided it by 150, and that's how we got to the 30%, negative 30%. So 80 to 100, we can see it was an increase of 20. 20 divided by 80 is 25%. Same thing for by supplies. It increased by 4. 4 divided by 20 is 20%. So we can see the percent changes. Vertical analysis is we show the relationship of the parts to the total. So what percentage of the total is each line item? And so a comparison statement, we're going to show the amounts for the financial statement, and then the percentage would be in a different column. It looks kind of strange to see, but a common size statement doesn't show the amounts. It only shows the percentages of the total. So that's kind of interesting, not seeing any dollar amounts, just seeing percentages. And the reason why vertical analysis is useful is because you can compare companies of different sizes. So you might have a competitor that's much larger than you are. You can compare yourself to your competitor. You can also compare your company to yourself, so your current numbers to previous numbers, when your company was much smaller, and kind of see how you stack up. And then also very important is we want to take these numbers and look at industry averages, especially when we talk about ratio analysis. We're going to want to be looking at what the norm is for the industry. So when we're doing vertical analysis for the balance sheet, we want to show what percentage of total assets is each asset. So we take the amount of the individual asset account divided by the total asset amount. For your liabilities and stockholders' equity, you want to take every individual liability or stockholders' equity account and see what percentage of the total liabilities and stockholders' equity it is. So we'll take that individual account and divide it by the total. And we know total assets and total liabilities and stockholders' equity always equal on a balance sheet. So you're basically dividing everything on the balance sheet by the same total. So here's an example on the balance sheet. So cash is 105. It's 105 out of the total assets of 229. So when we divide 105 by 229, we can see cash is 45.9% of our total assets. Divide the 100 accounts receivable by 229. Accounts receivable is 43.7% of total assets. Supplies, divide the 24 by 229. It's 10.4% of the total assets. All right, so now I want to take a look at the ratio analysis. Okay, and this is what you're going to be doing for your financial assignment. So I'm going to go through and explain the calculations that you're going to be doing, and I'm going to pull up the Amazon financial statements and demonstrate how to compute these ratios. So the first one is working capital. So this is one of the ratios that we use to evaluate our ability to pay our current liabilities. So to get your working capital, you take your current assets and you subtract your current liabilities. And so that basically tells you how much you have left over after you use your current assets to pay off your current liabilities. What do you have left? So you want to have an amount left to be able to meet some unexpected needs, but you don't want to have too much tied up in working capital. So let's take a look at Amazon's Form 10K financial statements. All right, so here is the balance sheet for Amazon. This is where we find our current assets and current liabilities we know on the balance sheet. And you can see here, they have it different. Usually you'll see the current year in the first column and then the prior year in the next column, but they don't for this one. 2018 is shown first and then 2019. When you're doing your financial analysis assignment, pay attention to how your company has the columns laid out. All right, so our current assets, right? We can see our total here, 96,334. We come down to our liabilities. Our current liabilities are shown first. Here's our total current liabilities, 87,812. So to get our working capital, we are going to subtract these numbers. So I have provided a template for you to use to do your financial analysis assignment, right? And of course, you're doing it for two companies. And so you'll see there's two columns and you'll be doing it for each of the companies. I'm just doing 1 year just to demonstrate how to do each of these calculations. So here I've entered the current assets and the current liabilities. It's good for you to show me this instead of just showing the division, even though it's very simple to do, because then that way I can see if maybe you pulled one wrong number, you can get partial credit. If you look at the rubric to see how the project is being graded, you can see the number of errors affect how many points you get. So then we're just going to subtract the current asset number minus the current liability number. So Amazon has 8,522 in working capital. That's what they have left over. Now, one thing that's really important, it says on the financial statements that the numbers there are in millions. So actually, we should be adding 6 zeros for the working capital. So it's $8,522,000,000 is what they have in working capital. Now, the working capital is the only calculation you're going to be doing in dollars. All the rest are going to be ratios. So this is the only one that you need to add the zeros on. For the others, just leave off the zeros because they will cancel each other out when you divide. So this is what they have left over to meet their any unexpected needs. So they can definitely cover their current liabilities, which is what we'll look at more closely in the current ratio and the asset test ratio. So why don't I wait to talk about that? So let's go take a look at what the current ratio is. So the current ratio shows if the company can use its current assets to pay off its current liability. So we kind of look at this a little bit differently. We're going to divide the current assets by the current liabilities. So we can see how many times the current assets cover the current liabilities. So a creditor is going to want to see a high ratio to make sure they have enough current assets to cover their current liabilities. They say usually about 1.5 is considered a strong current ratio. But you don't want it to be too high, because then that means you're not investing. If you have a lot of current assets left over after you cover your current liabilities, you need to be investing. It's kind of a balancing act. You don't want to have just everything sitting in your operating checking account, right? If you have an inflow of cash, you're going to want to invest it. So anyway, here we go. Our current ratio. Oh, another thing I would mention, if you looked at Walmart's current ratio, their current ratio is going to be less than 1. They can't cover their current liabilities. But Walmart has so much power over their suppliers that the suppliers, it doesn't matter if they take a while before they pay off their bills, because they can move such a high volume at Walmart that they don't worry about it. Plus, some companies also, they keep their current ratio low. They have a line of credit at the bank that they can use to borrow more money if they need to. So let's take a look at Amazon's current. Okay, so now I don't need to show all the zeros because, as I said, they cancel each other out. So for all the rest of your ratios, don't add in the zeros because we aren't talking about dollars. We're doing ratios. So we'll take the current assets, divide by the current liabilities. It comes to 1.09. And I would like you to round your answers to 2 decimal places. Okay, so it's 1.10. So they can cover, Amazon can cover their current liabilities 1.1 times. So it's not real strong, but it's adequate. Their creditors are going to be fine with that. The next ratio that evaluates a company's ability to pay their current liabilities is the asset test ratio, also called the quick ratio. So instead of looking at all of our current assets, we look at the ones that are easily converted to cash or are already cash. So cash plus your short-term investments plus your receivables then gets divided by your current liabilities. The big current asset that is missing is the inventory. So it shows whether or not you're able to pay your current liabilities if you can't move your inventory. If we can't sell it, will we still be able to cover our current liabilities? Let's take a look at Amazon's asset test ratio. So when we go to Amazon's balance sheet, we can see for 2019 they've got cash of $36,092. Their short-term investments, marketable securities is another name for short-term investments. So they have $18,929, and then a receivable of $20,816. So we can see the inventories are not included in this calculation. So when we add together Amazon's quick assets, cash, short-term investments, and receivables, it comes to $75,837. And then our current liabilities, we've already said, were $87,812. So when we divide, oops, I did that wrong. I subtracted instead of divided. It comes to 0.86. So if we can't move our inventory, if we don't have sales, we could only cover our current liabilities 0.86 times. So I mean, a creditor ideally would like you to see this at 1. 0.86, it's okay, and I don't think anybody's really worried about Amazon being able to move its inventory. So I would say Amazon can adequately cover their current liabilities. Our next 2 ratios are used to evaluate the company's ability to pay their long-term debt. So the first one is the debt ratio. We take our total liabilities and divide by total assets. And this shows you what percentage of your assets are financed with liabilities. A high debt ratio of, say, 0.75 or higher, that means 75% of your assets are financed with liabilities, would indicate trouble. Okay, so let's take a look at Amazon's. To get our total liabilities for Amazon, we need to add together the total current liabilities plus our long-term liabilities. When we add together the total current liabilities and the long-term liabilities, we get our total liabilities of $163,188. That's going to be divided by our total assets of 225, 248. I'll have to finish this in the next video.